get the chat box on. Right then, let's dive right in. So again, last minute adjustment to the Zoom link. Again, my fault. That's a little bit of miscommunication between myself and Sean. He's running a session at the same time. I normally use his Zoom account so that it pre-records it and uploads it and all that good stuff. So I'm just using my own Zoom for the moment. Again, this is what I normally use for my group of people anyway. So, well, with that said, let's dive right in. I've actually got a live one on today. For the eagle-eyed amongst you, it's going to be the opening range breakouts, ORB. And I use the first 30-minute bar here. Again, it's just setting up a game, so it's still valid and live for the moment. So there's a few extra pieces of information. So at its most basic, we have the opening range breakout. It's the first 30-minute bar. Now, to be fair, we've had a bit of time since the market opened, so you could call it equally the opening range 60. So as we've said several times in the past, one of the differences between the different names of the setups is pretty much down to the time that they set up. So this opening range breakout, it has caused a few questions. And all it is either the first 30-minute bar or the first hour of the day. So the first 30 or the first 6 minutes in there. And that's really all it is. And it's just the break of the high or the low of that 30 or 60-minute range. Typically, if we have like with the pulse bars, if we have a bearish bar, we'll be looking for a bearish trade. If we have a bullish bar, we'll be looking for a bullish trade. And it's a pretty standard setup that you can use. Again, there's the first 30 and 60-minute bars right now. Let me just zoom in, actually. Again, hello to everyone joining us. Again, mics are off, so if you want to pipe up and ask a question, feel free, or chat it in, or pop it in the chat box. Again, I have a slightly different format to my own Zoom account. So one of the things that we have here is, again, I was liking when I was doing my group session at the market open, I was liking this particular bar. So this does require a little bit of candle reading. It's not essential to the system itself, but there's a few extra pieces of information at the time that I really like. So I'll go through those right now so we can hopefully all expand our knowledge base on the market. So if I just go back out to what we have here. So the first thing is, again, let's just go back ever so slightly. I think... Jeff, you were asking this in the Discord. You know, when we have our Bollinger Band width at its narrowest narrow points, can we continue to narrow things down? So the first thing is here we have that pinch point
you have it on
of the Bollinger Bands.
Not on your purse. Oh.
Just be aware, everyone, your microphones are on. I'm just muting everyone. So just be aware that there's a different format to this particular group if you are chatting in the background. Right, so the Bollinger Band width is narrow. So what we're going to do is we're going to take that narrow point of the Bollinger Band and say, hey, you know, we've got a range at this point of the chart. So it's at this point here that I've marked off, we're saying, hey, we've got a consolidation. The reason why the Bollinger Bands contracts is because the market gets the ebbs and flows are getting narrower and narrower and narrower. We have this consolidation. So can we continue to, because they get narrower here, can we make the range narrower? So one of the things that Jeff was asking is, can we adjust our range to that point? I would argue no. And just be a little bit contradictory, you can at the same time do it. Now, I don't see any need to do it. It's just we've got a dramatic example on this occasion. And most of the time, there's not going to be such a significant difference. Now, what we see here is if we keep the original low of the Bollinger Band here, so we project that right, and we continue with there's the Bollinger Band high. So the high doesn't actually change, but the low would change if we were to make that adjustment. And we can see that that's happening just there. So that would be the possible adjustments. I would say that it's just not worth doing most of the time because you're just creating extra work. And again, what you'll find is that when you've identified the pinch points, so we've got the pinch points here, when you've identified the pinch points, it doesn't change a great deal. And if we stick with that original boundary low, we can see that it's well respected multiple times at the end of last week. So again, there's no need to make that adjustment first and foremost. Now, in addition to that, so I've got the horizontal range first and foremost. Okay, cheers, Jeff. No worries. I think it's fair to say you can do if you're a little bit more experienced. Again, when you become more experienced, you'll realize it doesn't really matter about that fine tuning, that you can do it in addition to it. So we've got that consolidation. Now, one of the things that I noted last week was we had this multiple touches of the high here. So I drew this up a trend line just as a speculative addition. So this is what myself and Sean sometimes refer to as OAND analysis. In addition to some of the things that we see from the system, I personally see some extra information. Now, what you see is going to be different from what Peter sees, Barry sees, Jeff sees, Pat sees. Everyone's going to see something different because you all see the chart differently. So this is under the title of discretionary analysis. It's additional analysis. So what most people do is they'll do draw trend lines or Fibonacci or something else, or whatever the thing is that you see. Again, some people are really good at Elliott Wave. In my other group, I've got one gentleman, and he basically spent the last 15, 20 years looking at Elliott Wave counts and analysis, and he really is the expert in the room when it comes to Elliott Wave. So what the mistake that I think people make is when you have discretionary analysis is they do it first. And what we should do is we should have a mechanical system, which we've got, that says, hey, when we tag the Bollinger Band low and we get our pulse bar, for example, okay, we're probably going to be bullish. Okay, great. So in addition to that, do I see some other analysis? So I can layer it on afterwards to either confirm my trade idea, my trade direction, et cetera, et cetera. So that's what we're going through today. We get the trade idea first and then think about the extra analysis that may confirm that trade idea. So this is why we refer to it as OAND analysis. Well, I've got the setup. I'm going to take the setup anyway. It's just today I've got some extra pieces of information that might give me a little bit of confidence, a little bit of extra information and confidence to place that trade. Again, I'm going to place it anyway. It's just today I've got a little bit of extra confidence. So that's the way I view these extra pieces of analysis and so forth. Right. Okay. So we've got the trend line here is what I drew there. So what I've done is, so that's the next piece of the puzzle. So we have and the best way of drawing trend lines, actually, if you're going to do a sloping trend line rather than horizontal trend line, is change the style of the chart to line charts. And what you'll find, let me just turn the pulse bars off so we can tidy this up a little bit. So what you'll find is when you draw, or when you pop the line chart on, you'll often find there's some hidden, so there's like almost 3 touch points there. We've got 2 touch points there. We've got a 3rd touch point there. We've got today's touch point there. So what you'll find is when you throw the line chart on is you'll be able to draw a trend line a lot more accurately just by changing the view a little bit. So if I just go back to the candle, there we go. So if I just go back to the candle, we can see that we have, there we go, that's the same view that we're just looking at. So we can see that we've got a few extra pieces of information. We've got those 3 touch points there. We've got 2 there. We can see 1 there and 1 there. And you'll see that it's not including that extreme high, and that's fine. It didn't include that because the line chart looks at the close price, but we have the open price there. So what we can see is just by switching to the line charts, in addition to the candlestick chart, we get this extra, this additional way of confirming the angle of the trend line. So I'm personally in no doubt that that's exactly where that particular trend line should be. It gives me, again, a little bit of confidence that I've drawn it as accurately as I can. And whenever you do draw a trend line, if you do decide to use them in addition, certainly these angled ones, is to make sure you've got at least 3 touch points. And we've got 1, 2, 3, 4, 5, 6, 7, and we've got an 8th one today. So I've got some confidence that that's the angle of trend line is as accurate as I can draw it. So what you'll find is when you recognize that, hey, maybe I've got a little bit of a sloping channel consolidation area, and we know it's consolidating. It's just we can have some extra boundaries. What I can then do is I can right click on that and I can do new parallel. It might be called something different on trading view, but again, we can duplicate the trend line, and that's where this lower boundary comes in. Now what I can do there, if I just put this full screen, what I can do now is I can take that duplicated trend line, and because the angle is the same as the upper boundary, I can play around with it a little bit, and I don't necessarily need 3 touch points. Because the angle is accurate, I can get away with the line of best fits. I can get away with 1 touch point, and what you'll find is that one side, so this upper boundary is pretty accurate as far as we've decided. But then this lower boundary, because the angle is based on the upper trend line, the lower trend line, I can get away with 1 touch point or whatever. So I've got 1 touch point there, almost there, a tiny one there, definitely there. So I would say that this is more the line of best fit. So we have multiple touch points, but it's not drawn in a traditional way. We've got that line of best fits. And again, I'm keeping with the confidence of that trend line because we have the line of best fits. We've got the angle based off the upper boundary, which is accurately drawn as far as I'm concerned. And I can put that lower trend line in wherever I think is the best place. And what you'll find is that one side, when you've got a channel like this, one side's going to be really well defined. I think the upper boundary is really well defined. And the lower boundary can be a little bit vague. And what you'll find is that one side, you may even end up with, if I just do another new parallel, what you may find is that you could draw like more of a zone. So you may end up with something like that on the lower boundary. It's possible to have that. I'm just trying to, again, illustrate areas where you can be a little bit flexible with these trend lines. So now that we've got our trend lines on, again, I've got an area. Firstly, to go back to our pinch points, I know that we're in a consolidation because of our pinch points. We've got the horizontal consolidation. But again, coming back to the original comments, in my case, I see something extra. Again, I used to use discretionary analysis quite heavily in my early days. So I'm used to looking at patterns, pattern recognition, consolidations, triangle patterns, head and shoulders patterns, etc. That was kind of my roots of chart reading. So again, I see that channel. Now, if you don't see it, don't worry about it. Again, this is why it's discretionary analysis. It's your discretion. So I'm just trying to, this is what I see. If you're good at Elliott wave and you see an Elliott wave count, if you see Fibonacci and you want to put Fibonacci retracements on there, Fibonacci extensions, if you want to do something else, Dow 3, GAN 3, Elliott wave, whatever the thing is that you see, that's what you do because that's what you bring to the table. Again, in my case, again, patterns, again, I'm quite familiar with a lot of different patterns and so on and so forth. So again, I've got this channel. That's the first and foremost. And that was drawn at this point last week, just for reference. So I can leave that on. So although we've got the breakouts here, we've come back inside that range. And we've almost respected the upper and the lower boundaries. When we continue to draw that trend line, this is where it stopped on Friday. That's where it started on also on Friday. But then when we come to today, we can see that, hey, this location looks kind of interesting now. Now that we've got that extra piece of information, that looks good. Now, I'm going to look for a trade anyway, first thing in the morning, the morning pulse bar, the morning session, the opening range breakout, as we mentioned earlier. I'm going to look for a trade, but now this location looks really good. And again, when we think about our 6 money making patterns, I want to, again, when we're in a range, I want to buy range lows or sell range highs. Well, now we've got this horizontal range and a sloping range. So if I want to be a seller at range highs and a buyer at range lows. Well, where are we in the context of our new extra piece of information? I've got this downward sloping trend line / channel, and we're at the upper boundary. Okay, great. So if I'm going to place a trade, it's probably going to be bearish because we're inside the range, and I'm going to trade it from the range high down to the range low. Now, because that's not a huge move, I might not get the full credits on my trade. So this might be a very quick trade and hopefully, possibly, fingers crossed, out by lunchtime. Because again, I don't really think there's going to be a big move today. I think we're going to see a narrow range in day. I'll explain my reasoning for that in just a moment. But I think we're going to see a narrow range in day. I think we're going to see a slightly bearish movement. And again, this is just my opinion, but it's in addition to the things that I'm looking for. So if I'm going to place a trade today amongst all of this mess that we have that we're calling the range, then firstly, I've got a great location. I've got price at the upper boundary of an additional descending channel. Now, what we can also do is we can look left across the chart and say, hey, price stopped there previously. If we continue to look left, price has stopped here previously. Price has stopped there previously. It stopped there previously. It stopped there previously. It stopped there previously. It stopped there previously. Okay, great. So now we've got another piece of the puzzle. So in addition to the sloping trend line, we've got this horizontal location that suggests that, hey, this is what we would call resistance. I'm just going to put res there. Again, prices below this sticking point, the stopping point. Again, it's coming up to it, so we'd call it resistance. So I've got this trend line, I've got this horizontal. Now, just as a bonus, if we look back at our horizontal trend lines, it's about halfway between. Just an observation, but maybe I can do something with that in the future. So we're at the midpoints of our range, the upper edge of the descending range, the midpoint, which is also acted as certainly the launching point for several moves inside that consolidation. So this is now looking like a great location. Now, let me just press pause there. Is everyone happy with that? Again, everyone's got microphone access. You want to toggle off, feel free to talk. If you want to type. Again, I'll just give it a moment just to allow people to absorb that and just say, hey, this looks good. Does everyone kind of get what I'm saying here?
Yes.
Awesome. Cheers, Jeff. So we're building a picture. Now, we come back to the original points. If you're brand new and it's day one, you don't need to do any of this. It's not mission critical. And this is why we call it O&D analysis. With time, with experience, the only thing that I can't give you is experience. I can give you the benefits of it, which is what we're doing right now, but I can't give you experience. You've got to kind of put a bit of work in. Now, with that said, we come back to our original thing. If I'm going to place a trade, I've got a bias. Again, we're at that resistance. I'm going to trade from the upper boundary to the lower boundary. Where are we now? We're at the upper boundary. If we were above that, then I'd be tempted to be bullish and trade the breakouts up to that larger range that we're just looking at. But we're not there yet. So for the moment, I've got a bearish bias. I'm thinking we're going to go from the upper range down to the lower range. And that lower range is about the same as our horizontal range. So they're about the same thing. So let's just call that 58.10. So we're about there. So if I'm going to place a trade, it's going to be selling at resistance at the upper channel, and I can use standard setup. In this case, I'm looking at the opening range breakouts. And when I was with my other group earlier, we were looking at this first 30-minute bar. So all we did is we looked at that first 30-minute bar and we said, hey, this is a great location. We've got some extra pieces of information, which means that I can be a little bit aggressive and not necessarily wait for a pulse bar. And I could be super aggressive and just take the trade at that location because it's a great location, which is what I was tempted to do in fairness. Or I can wait for setup, that first 30-minute bar, and take the break of the low of that bar. Now, I'm going to take the trade anyway. But to be fair, the opening range breakup, this is like one of those optional extra trades, as we said. We've got the choice to do that, but now we've got this extra information to say, hey, this is a great trade. This is a great location. I'm liking the look of it. Because of the extra analysis that we've done, it means that I can have confidence in this opening range breakout. Again, it's a choice that we have. And again, what other choices that we have? I can either just place the trade as I would normally. I can increase my position size. Based on analysis, you can decrease position size to say, hey, I've got less confidence in this. And what I don't want to do is not place the trade because the setup's valid, but maybe I just reduce my position size, and that's a valid reason based on the same logic. For whatever reason, you might go, based on my analysis, I've got less confidence in this for however you view it. And that would be an okay thing. And it just means that we're not scaring ourselves off the trade, but we're just kind of turning the position size dial up and down, or being accelerating the trade choice or delaying the trade choice based on what we're viewing and what we're seeing on the charts. And so this is how I viewed the charts this morning. We've got a great location, and the opening range breakout was the trade. Again, it's still valid right now. So again, another question that we've had in the Discord this week is, can we have a setup in the first 30 minutes, place it 2 hours later? Yeah, I mean, that's the situation we've got right now. So if it goes below that low again, the opening range low, that first 30-minute bar, then yeah, you can place that trade and not worry about it. So that's my trade for the day. So do I think there's going to be a big move is the next part to it. So big move, no. Do I think there's going to be an opportunity for max credits? I mentioned earlier that I think we're going to be breaking through that low. We're going to be pushing to that low. And that move, that's about $15. It's not a huge move. So for me to get max profits, again, if I let's just say I collect $2.50, which I did on this particular trade, and I want to buy that back for 30 cents, then I need usually $20 to $25 of directional movements to get that out. So I might have to wait. So I might get the directional move, but I might also have to wait time-wise till near the end of the day before my target exit is reached. I don't really want to wait to the end of the day. Again, I want to get a nice quick trade. So the other thing that I mentioned is, again, I don't think there's going to be, firstly, we can see there's the potential is from range high to range low. I also don't think there's going to be a big movements. We've got no news today to potentially drive the markets. So just looking at the daily chart for a second, one of the things that I typically see quite regularly is when we have a bar, and this is true for any time frame, when we have a bar that's kind of half body, half wick, you've got that situation. Normally the following bar, or in this case, the following day, is a narrow ranging day. And that's my expectation. And we see that last Thursday and Friday. We have this wide ranging bar on Thursday. And then on Friday, my apologies, not Friday, my apologies, it's Wednesday, Thursday. So we've got Wednesday, and then Thursday, we have this narrow ranging day. And then Friday, we have that similar day where it's the other way. So I would anticipate there to be a narrow ranging day, because that's normally what happens. And if you look back over the charts, whenever you see a spike, a big wick, where you've got that big body, big wick, normally the bar afterwards just pauses. It just rests for a while, and you'll see that quite regularly time again. So again, this is just, again, one of my own observations. And again, I've seen it time and time again. So that just adds to the flavor of the trade. So again, we've got the potential from the range high down to the range low. Plus, I also think there's going to be a narrow ranging day. I don't think there's going to be a huge trending move. So I want to be, personally, I'd like to be out this trade by lunchtime. That would be my ideal scenario. And if we get a big directional move, that'd be great. But I'm not expecting a big directional move. So I think there's going to be a small move down of about $10 to $15, because that's the potential, reinforced by we're expecting a narrow range day today. There's no news to drive the markets. There was a big wick on Friday's high, so today's probably going to be a rest day. We've got lots of news out this week, so we'll probably see some movements, but just not today. So if we see that $10 to $15 move, then if we collect $2.50 credits, then I'll probably get $1 to $1.50 profit with that type of movement. So it just allows me to, again, coming back to the O&A analysis, I can wait to the end of the day and hope for maximum profit for a 0-day trade, which is what I've done. Or I can decide on, I'll take less profits, but it's within my expectations. So if I've collected $2.50 for my credits. Again, I did the at the money spread. And maybe I collect $1 to $1.50 on this occasion. Let me show you how that might work out. Let me just get my brokerage up for a second. How do we work that out? Well, you can do this a variety of different ways. Again, I've got a few trades on, bear with me. Right, okie dokie. So I'm just going to set up an at the money spread. So there's your at the money bearish spread. So okay, so this is the short strike is 58.30. It doesn't matter. It's just at the money. One strike in the money, one strike out the money. On this occasion, it's $3 in premium. So if I move the whole spread up, if I move the whole spread out, so what I can do, if I know that the at the money spread is $3, what I can do then is if I move the whole spread $5, $10, $15 out the money, as if that was an open trade, then I know that it's going to be worth about 85. So let's just call it $1. It's going to be worth about $1. So a $15 move might make me $2 in premium. Does that make sense? Everyone happy with that? Now, in fairness, we're right at the 235 strike. So let me just set this up. So 35 strike. Oops. Let me just. The 35 strike is there and there. Okay, so the 35 strike is currently worth 240. I collected 250. It was a little bit higher when I placed my trade. So the 235 strike is my 58.35 is the short strike. So $2.40 is the credits. So that's about what I received, and it's about what you'll get if you place the trade right now. Again, I wouldn't go in the money with this spread just because I'm expecting a small movement. But how much? So if this moves down $15 down to 58.20, the range low that we were just talking about. Again, I can go from at the money to $5 out the money, $10 out $10 out the money, and now $15 out the money. Let me just. Why is that not? Just bear with me. But trading view been a little bit funky. So now we've got $15 out the money, 5, 10. So I've just moved the whole spread, $15 out the money. And what that will do is it will synthesize the potential profit. Now, there's a better way of doing this, but this is the back of the envelope way. So we can see that my $2.40 spread, if it went $15 out the money, which is what we want as a credit spread trader, then I could buy that back for 85 cents. So again, let's just call it $1 to make the public math simple. So let's just call it $1. So if we were to move down at $15, my spread's going to be worth $1, and I can collect plus 1 minus 1. I can collect about $1.50 as my profits. Does that make sense? So I now got a target in mind for the option based on what the SPX can move. Let me press pause there. It's a little bit number heavy, but does that make sense? It's just a back of the envelope way to work out. Okay, if I think there's going to be a $15 move, is hoping for maximum credits viable today? It's possible, but I think what's sensible is to aim for $1.50 profits. What do you think? See it? Don't see it? Get it? Don't get it? Let me know. Yeah. Cheers, Jeff. Awesome, SJ. Thanks. Yeah. So again, we can use the extra analysis, the O&A analysis that we've been doing, to not only find an entry that gives me a lot of confidence, I can also use it to find an exit that makes perfect sense on today's occasion. Now, I might make maximum profit by taking it right to the end of the day, But as we're moving right now, I could be out by lunchtime with $1.50 profits versus what if, to be fair, we see prices yo-yo around at the moment. So it makes a lot of sense to me to not worry about the maximum trade, to be fair. So we've got the $15 profits, and I'm aiming for $1.50. Perfect. That's what I'm looking for. So I could place my automatic buyback order. So if I collect $2.15 credits, I could buy it back for $1. Now, what I do, the caveat to all of this is what I do is, let me just get my brokerage up again. I always place an automatic buyback order. So these are my SPX orders for today. I've got a couple of trades on. I place an automatic buyback order. So this is today's trade. So I've filled at 250 and I've placed an automatic buyback order for 30 cents. I know you just said $1, Phil. I know. I always place a trade to buy back for 30 cents, whether it's a day trade, a swing trade, whatever trade. Because what if something unexpected happens? What if we drop 50 points in the next 10 minutes? It's not impossible. It's unlikely, in fairness, but it's not impossible. So I'll place an automatic buyback order. And to be fair, if I wasn't doing this call, I'm going to be nursing my wife, who's still getting better. The stitches are out, which is great news. But I can go and do other stuff. I don't need to be at the desk, but I can check this on my mobile. So I place the automatic buyback order because I can keep an eye on the current price. So the current price is there. And I can say, I'm making 40, I've collected 250, I'm making 50 cents profit. Great. And if the market was to drop, and again, I've got an alert set for 58.20. And by the time I look at it, maybe I can get 85 cents. Maybe I can get 75 cents. Maybe it just falls off the face of the earth and I get to buy back at 30 cents. Great. I've got that long shots in the market waiting already, just in case. But I can easily manage the trade. So when my alert goes off, because again, after I finish this call, I'm actually going to the doctors. I've got a pesky ear infection again. It just won't shift at all. So I'm going to be going to the doctors. But I've got my order in and I can check on my mobile phone. I can say, okay, well, I've got 30 cents order. It's currently worth $2 or $1.95, $1.50, $1.40, $1.30, whatever. And if I'm in the doctor's waiting room, I can decide whether, what I want to do when my alert goes off. Again, maybe I get lucky. Maybe it does fall off the face of the earth. I've got my order in for just in case. But I can manage that very easily on my mobile phone. It's very easy to cancel and replace. And it's easy to update something on a mobile phone versus trying to trade on the mobile phone. So again, just a way that I like to manage my own trades. So I've got my just in case order, in case it does fall off the face of the earth and I can buy it back for 30 cents. That'd be great. I can check it at lunchtime. Again, I'm going to check it in the next hour or so, or to be fair, in the next hour I'll be at the doctor's, but hour and a half, 2 hours. And I can manage that very, very easily and, without having to faff around. I can just say, hey, the current price is this. I want that. Okay. Am I happy with it? Yeah, that looks great. Now, one piece of another and analysis, which I forgot to mention, ADD. We're currently at a bullish extreme. Now, the way that this works, it's kind of like an oscillator. We've been through this on previous sessions, but we've gone from bearish extreme to bullish extreme. And what we can expect, ADD is kind of like it's a mean reversion tool. It lets us know where market extremes are. So we're at this bullish extreme. I would anticipate price to come down to that midpoint there. So just another reason to be bearish is all I'm trying to get to. So again, I'm liking it. Looking good. We've got some O&A analysis that gives me the locational confidence that, hey, this is a good location. Maybe I can place the trade. And the same O&A analysis, the extra pieces of information that would suggest, hey, maybe I don't go for the big targets. I'm going to put it in anyway, just in case. Again, while I'm away, anything can happen. But I'm also able to manage that quite quickly. So when my alert is triggered, I'll get a little push notification on my mobile phone and say, hey, 58.20 has been reached, and I get to decide what I want to do. Do I want to take it or, give it half an hour and see if it goes further? And that's the choices that I've got. So, any questions, comments, observations? Everyone happy with the sessions? A little bit different, talking about the extra analysis that we can all aspire to do. If you get it, great. If today's your first, metaphorically your first day, first week, first month, don't worry about the extra stuff. Practice it. Practice makes perfect. The only thing I can't give you is experience, but practice the trend lines, practice the extra analysis. If you're interested in GAN3, GAN3, Edit-Wave3, whatever extra piece of information that you can, hopefully you can see, you can use it to complement what we're doing here. Again, I'm going to place the trade anyway. It's just today I've got some extra pieces of the information that I recognize based on how I've traded in the past.
Hey, Phil.
Right. Any final thoughts, comments, questions, anything you need from me while you've got me? Otherwise, I'm going to hang my spurs up and call it a session.
I've got a quick question back on the Orbi. So
yeah, sure.
I see where the 60-minute broke the 30 minutes. What if it was the fourth or fifth bar that finally broke the 30 or 60 low? Is that still viable?
Yeah, it's fine. Yeah, it's nothing wrong with it. So
we're looking at 30 and 60, but it doesn't matter how long it potentially takes.
Correct. So technically the low of the 30 was dinged there, and then we also get the high of the 60-minute range there. So let's just say that never happens. So let's just say that, hey, that's the high there. Let's just say, like right now, you're looking at the trade. Hey, so you mark off, there's the 60-minute high, there's the 60-minute low. It's the same as the 30-minute high or the 30-minute low. It's about the same. So if I was looking at this right now, if I had something else to do, if I'd been in the doctor's a little bit earlier today and coming, now was the first time I was sitting down, I'd say, okay, well, I've got my location. I've done all the analysis. I've got a good location. Oh, and the market's not moved just yet. But right now, it's just dinged the range low, which is in line with the analysis that we've just done. Okay, great. So I'm going to place the bearish trade. It's 2 hours later. So you can place it later on the day. It doesn't have to immediately break the high or the low. It's the same with any of the pulse bars. If you have a pulse bar that sets up, and let's just say that we had that bearish pulse bar on the first candle of the day, and you leave it an hour, 2 hours, 3 hours, whatever, and you're looking at the chart right now, you go, actually, it's about the same level. If you were at the charts in the first 30 minutes, you'd be placing the trade. So you're looking at the chart right now, it's about the same location. So it's still valid 2 hours later, 3 hours later, whenever it is that you're looking at the charts. So it's always going to be, I'm thinking about the strikes. I mean, what if we were just a little bit lower like we are now? So let's just say that we were $5 lower. The market's already started moving. Then your at-the-money trade. So if you put the trade on as it breaches that low, then the short strike would be 58.30. But if the market's selling off, and let's just say that, imagine that it's $5 lower and we're at 58.25, then your at-the-money strike is going to be 58.25 because that's the one strike at the money at the time that you look at the trade. So the setup is relative to when you place the trade. Now, another argument might be the first 30-minute bar's being breached. You've got the ORB 30, and 45 minutes later, you go, actually, we're at the high there. And you might go, you know what, I should be in that trade, bearish, but it's now $10 higher. And maybe you can use the 40 strike as your one strike at the money. That would be a perfectly valid trade as well. That would be a little bit aggressive, a little bit adventurous to do that, but that would be okay as well. Because if you were watching it in the first 30 minutes, you would have placed the trade with a short strike at 30. But as price rallies, you go, oh, actually, I can do one or two things. I can do 2 or 3 strikes in the money and collect $3 in premium, or I can go the 40 strike and collect $2.50, and I've got all that wiggle room. So you can make some adjustments. It's always it's relative to when you're looking at the trade to place the trade. The trade itself is valid, but this is just a few different scenarios where that would be okay.
And if we're dealing with the PDT, is it still safe to do it as a one-day expiration?
Sorry, PDT, patent day trader.
Patent day trading.
So so that does thing. So the patent day trader rule means that you can place 3 trades in a 5-day period. Now, when I say place, you can open and close three times in a 5-day period. And it's on the same day. So if I was placing this trade, I would be buying it back later today for a profit. That would be one of your pattern day trader rules because it opens and closes today.
Right.
Now, if you wanted to have this as a swing trade, you could all the analysis that we've done. Hey, we've got this great location. Got this great location here. We're bearish on that. We're at this bullish extreme and we're expecting the ADD to go from one extreme to the other. And you might say, instead of the day trade, I could use this entry as my swing trade. And you can have, and a swing trade is anything that you're going to hold overnight. So you can go anywhere from 1 to 7 days in that scenario, and you don't have to worry about the pattern day trader rule. So me personally, if I had, because I've got swing trade on from over here, so I don't need a swing trade. If I was looking for a brand new trade and I was looking to get positions, then I would use this as my swing trade to get a 7-day to expiration trade on. That would be my first trade. And then I would, every new trade that develops after that, I would add into that swing trade. And if you want to avoid the pattern day trader rule, it's going to be at least 1 day. And typically when I'm adding in with any of the setups, I typically do 3 days to expiration. The reason why I do that is I don't have to worry about being glued to the desk. This is just one of those experience things. Again, it's just one of those personal preference. I like to place the trade and walk away. I don't like babysitting my trades. Like today, I will place a 0-day trade, but my intention is to close it quite quickly. So again, I've got that plan in mind. But again, if I was thinking about a swing trade, it's the swing trade on first, and then any of the other setups that are in line with that swing trade, I'm going to use to compound in, and it's going to be anywhere from 1 to 3 days to expiration. So with the intention of holding overnight. Again, just so that I can put the trade on and not worry about having to babysit it at all.
Perfect. Thank you.
I don't really do anything with the microcaps, Jeff, so I've just seen your question in the chats. Yeah, you can trade futures. Yeah, this same system works with futures. I do trade it with futures. So let's just go to the futures. So I would use if you're going to trade the same system with futures, then you don't have to worry about pattern day trader rule. I would use a 60-minute chart. S&P futures effectively goes 24 hours a day. And what I would do is in addition, so you've got your tag and turn. In addition, what I would do is look for, so let's just say that's our low there. I would look for the tag. The pulse bar as well. The pulse bars aren't as effective on futures. They do work, but they're going to be less effective. But I would look for that rally and the sell-off, and I would look for that little V-shaped pattern there and use the apex that be. So I'd use a little bit of pattern recognition to take the tag and the turn. So for example, you've got last week's tag, you've got the rally. It just pauses overnight. You've got 2 pauses there. And I would take that trade on there with stops below the low. You're going to need stop losses. And again, you're still targeting the upper boundary there. So we've gone from the target there. Didn't really get a setup on Friday. We've come back to the upper Bollinger Bands. We've pushed lower. There's that V-shape entry. So your futures trade would be just going bearish now to tag from the upper Bollinger Bands to the lower Bollinger Band with that little V-shaped pattern there. As we go through 58.65 or so. So you can trade the same strategy with futures if you want to avoid the pattern day trader rules. You want to be a little more active, a little more aggressive. Just be aware that your win rate's going to be lower because you're going to be stopped out. Whereas with the credit spreads, we don't have to worry about being stopped out. We don't have to take re-entries. But you'll see the same types of patterns again. You've got the tag turn, the V-shaped entry. As we come up to the upper Bollinger, you've got the V-shaped entry there. So here's an example of you would be stopped out. But as you get stopped out, you've got the pullback. You can take the re-entry and get back bullish. You've got the tag and the turn there. Again, we don't really come down to the lower Bollinger Bands again until here. And then you've got those V-shaped entries all over the place. So yeah, you can trade the same strategy on futures. It just requires a little bit more hand-holding for the same trade.
Thank you.
Same thing can be used on stocks for swing trades. just for reference. In case you were wondering, if you want to place the trade on Apple, you want to do it on, again, I've the same strategies applied to swing trading. So if you want to do that, you can do. Again, you've got the same principles being used. You're looking for breakouts, reversals, continuations. So again, it's just, don't tell anyone, it's a secret. The same thing works on anything. If you want to trade the same thing with crypto, the pulse bars work really nicely on crypto. So Sean says, I don't trade crypto a lot. They're just one of those personal preference things. It's not my bag, baby. But yeah, if you want to trade crypto, it certainly works with it. This kind of strategy started out for me back in 2001. Space Odysseys were not included, but yeah, 2001, and I was trading Forex, proper currency. Crypto didn't exist back then, but yeah, it's a variation of what I've been doing for 25 years full time. Yeah, almost 25 years now, 30 years total. But yeah, this is I went full time back in the early noughties. Right, I'm just doing the fact, folks. Any other questions, comments? Anything you need from me? Now's the chance. Go in. It's gone. Right, folks. I will see you at the same time next week. Good session. We'll be back to the usual link for the calls next week. But yeah, this is not being recorded, so if you've turned up, great. We'll try and do an official link similar officially next week. So again, thanks for turning up live, and I will see you next time. Oh, cheers, SJ. Thank you very much. Yeah, it's not been recorded, Dan, so if you've got any follow-up questions, just post them in the Discord, and as soon as I see them, I'll get to them. Right, folks, see you all at the same time next time on the usual link next week.